All right, so today we're really diving deep into something pretty major for a lot of people, I think. We're talking about home mortgages in Kenya. It's a big decision, right? Like moving from renting to actually owning and building equity.
Yeah, it is. It's a huge step for a lot of people. And honestly, mortgages can be a little confusing, There's so much to figure out.
Absolutely. I mean, even for those of us who kind of follow the real estate market and all that, it can still feel overwhelming. So that's exactly why we're here, right? To break it all down and make it clear and easy to understand.
And exactly. We want to empower you to make those decisions confidently.
Now, we've been digging into this recent guide, and it's got a ton of great info. But before we get too far, let's start with the basics. What exactly is a mortgage? Like if you were explaining it to someone who's never even heard the word before.
Okay, good point. Let's simplify it. Imagine this. You want to buy a house, right? But you don't have like hundreds of thousands of shillings just lying around. So you get a mortgage. It's basically a loan that's specifically designed for buying property.
Okay, makes sense so far.
But here's the thing. The property itself kind of acts as a guarantee. You're the borrower, or what they call the mortgager, and the lender, usually a bank, is the mortgagee.
So it's like you're saying to the lender, hey, if I can't pay you back, you can take the house.
Yeah, that's the security part of it. That's why lenders are pretty careful about who they give mortgages to. They want to make sure you can actually repay the loan. But the cool thing is, every time you make a payment, you're not just paying off debt, you're actually building ownership in your home. That's called equity.
Okay, I see. So it's not just throwing money away on rent. You're actually working towards owning something. All right, now let's decode some of the lingo. Honestly, some of these mortgage terms can sound like they're in a different language. We're talking principal, interest rates. Where do we even start?
Let's break it down. The principal is simply the original amount you borrow, the core of the loan. Then you've got interest, which is basically the lender's fee for letting you use their money. Think of it as the cost of borrowing.
Right, so the interest is what you're paying on top of the actual amount you borrowed.
Exactly. And the interest rate is just that fee expressed as a percentage.
Gotcha. So if the interest rate is higher, you're essentially paying more for that loan.
You got it. Now, things can get a bit trickier when we talk about fixed versus adjustable interest rates. A fixed-rate mortgage, just like it sounds, means your interest rate stays the same for the entire loan period. So your monthly payments are nice and predictable.
That sounds reassuring, knowing exactly what you'll be paying each month. But there's always a but, right? Nothing's ever that simple.
Well, the potential downside is that if market interest rates drop significantly after you've locked in, you could be stuck paying a higher rate than you might get elsewhere. Kind of like buying a plane ticket, then seeing the price drop the next day.
Oh, I totally get that feeling. Missed opportunity. So, okay, adjustable rate mortgages, how'd those work?
With adjustable rate mortgages, the interest rate can change. It fluctuates based on what's happening in the market. So the rate might start lower, which can be really appealing, but there's a risk that it could go up, making your payments less predictable.
So it's a bit of a gamble. You might get a good deal initially, but you're also taking a chance that those rates could climb later on.
Right. It's all about figuring out your own risk tolerance and how comfortable you are with that uncertainty.
Got it. And then there's this word, amortization. Sounds kind of scary, honestly. Can you break that one down for us?
Amortization just refers to how your loan gets paid off over time. Usually, each monthly payment covers both the principal and some interest. So with each payment, you're chipping away at that total loan amount.
Okay, I'm picturing like a pie chart. With each payment, the debt slice gets smaller and the ownership slice gets bigger.
Exactly. You're slowly but surely taking bigger and bigger bites out of that debt pie.
I like that visual. So we've tackled principal, interest, and amortization. But there's a whole bunch of other terms that go along with mortgages in Kenya. Let's walk through some of the most important ones. What should our listeners really make sure they understand?
Okay, great idea. We should definitely talk about the title deed. It's basically the official document that proves you own the property. No title deed, no mortgage. It's that simple.
So before we even think about mortgages, we got to make sure our ownership is all clear and legit. No cutting corners there. What about the down payment? I know that's a big one for a lot of people.
Yeah, the down payment is the initial cash you have to put down before you can get a mortgage. It's usually a percentage of the property's price, maybe 10% to 20%, maybe even more. It shows the lender you're serious about buying the property and have some skin in the game.
Right, like you're putting your money where your mouth is. You're not just browsing, you're committed. Now, let's flip the script for a second. What happens if you, hit a rough patch and can't keep up with those mortgage payments. We hear the word default a lot. What does that actually mean?
Default basically means you've missed payments and haven't followed the terms of your loan agreement. The lender might try to work with you, but in the worst case scenario, it could lead to foreclosure.
Foreclosure. That word always sounds so serious. What exactly does that involve?
It essentially means the lender takes possession of the property to try to get their money back. It's their last resort, but it just goes to show how important it is to take that mortgage commitment seriously.
Definitely not something you want to mess around with. Okay, now what about equity? That word comes up all the time when people are talking about homeownership.
Equity is just your ownership stake in the property. As you pay down the mortgage, your equity increases, you're building wealth bit by bit with every payment.
So it's like you're earning a piece of the property with each payment. That's pretty motivating, actually. Okay, we also need to talk about this thing called debt-to-income ratio, or DTI. I hear lenders look at that pretty closely.
Oh, they do. It's basically a way to check your financial health. They calculate it by taking all your monthly debt payments and dividing that by your gross monthly income.
So it's not just about how much you earn, it's about how much of your income is already going towards other debts.
Exactly. The lower your DTI, the more likely you are to qualify for a mortgage.
Okay, that makes sense. They want to make sure you can actually handle the extra payments. Now let's talk about those scary closing costs. What are those all about?
Closing costs are basically those extra expenses that pop up when you're finalizing the mortgage, like processing fees, valuation fees, legal fees, things like that.
So it's not JST, the down payment. There's even more to consider.
Right. It's all those extra little, or not so little, things that can really add up. So it's smart to factor them into your budget early on.
Agreed. Nobody wants to get hit with surprise costs. Now, what about paying off your mortgage early? Is that a good thing or a bad thing?
It seems like it should be a good thing, right? You're getting rid of debt faster. But sometimes mortgages have these things called prepayment penalties, which are fees for paying it off too quickly.
Seriously. You can get penalized for being financially responsible.
Sometimes. Some lenders aren't too happy about early repayment because they lose out on the interest they would have earned.
That's wild. So it's really important to read the fine print and understand the terms before you sign anything. Okay, what about escrow? I've heard that word thrown around, but not sure what it means.
Think of escrow as like a neutral third party who holds on to some of your money to cover things like property taxes and insurance. So you pay into it with your mortgage payment, and then the escrow agent makes sure those bills get paid on time.
So it's like a built-in safety net. That makes a lot of sense. Now, what about refinancing? Should people be thinking about that down the road?
Refinancing basically means replacing your current mortgage with a new one, maybe one with better terms. So if interest rates go down or your financial situation changes, it could save you money in the long run.
Okay, so it's like a mortgage do-over.
You could say that. It's a chance to maybe get a better deal.
Makes sense. And lastly, what about mortgage insurance? Why would a lender require that?
Mortgage insurance is there to protect the lender if you can't make your payments, especially if you didn't put down a big down payment. It helps reduce their risk so they're more willing to lend to you in the first place.
Right, so it's all about balancing the risk between the borrower and the lender. Well, we've covered a lot of ground. We've decoded all these mortgage terms, and I bet our listeners are feeling a lot more confident already. So, what's next on our deep dive?
Now that we've got the lingo down, let's talk about the different types of mortgages you can actually get in Kenya.
Wait, there's more than one kind. This is getting interesting.
There are. It's not a one-size-fits-all kind of thing. Just like, you wouldn't buy just any car or any phone without checking out the options.
Right. Makes sense. So, lay it on me. What are my mortgage choices?
Okay, well, the most common one you'll come across is the fixed-rate mortgage. Pretty self-explanatory, right? The interest rate stays the same throughout the entire life of the loan.
Okay, that makes sense. And the advantage is?
Well, the big one is predictability. Your monthly payments are going to stay the same, which makes budgeting a whole lot easier.
Yeah, consistency is definitely nice when it comes to something as major as a mortgage payment. But I'm guessing there has to be some kind of trade-off, right?
You got it. The potential downside is that if market interest rates go down significantly after you've already locked in your rate, you might end up paying more than you would if you had waited.
Ouch, yeah. That's like the feeling of buying a plane ticket and then the price drops the next day.
Exactly. It's all about timing sometimes. So then you have adjustable rate mortgages, and those are, well, a bit more of a gamble.
Oh, yeah. We talked about those earlier. A little bit riskier.
Exactly. The interest rate fluctuates, meaning it can go up or down over time. So you might start off with a lower rate than a fixed rate mortgage, which can be appealing,
But then it could jump up later and those payments could really start to bite.
Yep, that's the risk. So it's about knowing your own risk tolerance.
Right.
And also kind of trying to predict what's going to happen with interest rates in the future, which is, not always easy.
For sure.
Yeah.
Crystal ball would come in handy about now.
All right.
Okay, so fixed rate and adjustable rate, are those the only options?
Well, in Kenya, you'll also find what are called Sharia-compliant mortgages.
Okay, I'm not familiar with those. What's the difference?
They're structured to align with Islamic principles, which means they don't involve charging interest.
Oh, interesting. So it's a way for people to get a mortgage that fits with their beliefs.
Exactly. Instead of interest, it's more of a profit-sharing model between the lender and the borrower.
Okay, so there's definitely more variety in the market than people might realize at first glance.
Absolutely. It's not just about banks either, although they do make up a big chunk of the market. You also have SACCOs. Those are savings and credit cooperative organizations, and MFIs, or microfinance institutions.
Right. So those offer alternatives to traditional bank loans.
They do, especially for people who maybe wouldn't qualify for a bank loan. They can be a great option.
So when we talk about mortgages in Kenya, are we talking, what kind of amounts? Hundreds of thousands of shillings, millions.
Well, the average mortgage loan size in 2023, get this, was 9.4 million shillings.
Whoa, okay, that's serious money. So with those kinds of amounts, what kind of interest rates are we talking?
Yeah, well, the average interest rate was around 14.3% in 2023.
Okay, and what about the length of these loans? How long are people typically paying these off for?
Well, that's called the loan tenure, and it can vary. But typically, you're looking at somewhere between 5 and 18 years. The average is about 11.7 years.
Okay, wow. That's a pretty long commitment. All right, so we're getting a better sense of the lay of the land, so to speak. Now, let's talk about the qualification process, because let's be real. Applying for a mortgage can be kind of nerve-wracking. You're basically laying bare your entire financial history.
Yeah, no doubt. It can feel like you're under a microscope.
So what are lenders really looking at when they're deciding whether or not to give you a mortgage? What are the key factors?
Well, the first and most important thing is income. They want to see a steady, reliable income, whether you're employed or self-employed. That's how they know you'll be able to make those monthly payments.
So job security is key.
Absolutely. Then there's your credit history. A good credit score is like gold when you're applying for a mortgage. It shows you're responsible with money and, likely to repay your debts.
Yeah, those credit scores can really follow you around.
They do. And the last piece of the puzzle is the property valuation. The lender is going to get the property professionally assessed to make sure it's actually worth what you're asking to borrow.
Right, because the property is basically the collateral for the loan.
Exactly. They want to make sure they can recoup their investment if things go south. So to sum it up, it's all about income, credit history, and property valuation.
Got it. Those are the three pillars of mortgage qualification. Now let's talk about the less glamorous side of things. The costs.
Yes. The cost.
We know there are monthly payments, but what else? What are those hidden costs that people should be aware of? What else is lurking out there?
Well, on top of your principal and interest payments each month, you'll also have things like processing fees, which are usually a percentage of the loan amount.
Okay. Anything else?
Oh, yeah. Don't forget about valuation fees. Got to pay someone to assess the property's worth, right? And then, of course, there are legal fees. All the paperwork, the registration, all that fun stuff.
Sounds like it's a whole parade of fees. It's like buying a plane ticket and then getting hit with all those extra baggage charges.
Huh. That's a good way to put it. And we can't forget about insurance. You'll usually need both life insurance for yourself, the borrower, and insurance for the property itself. And then there's stamp duty, which is a government tax on property transactions.
So all those extras can really add up, huh?
They can, and that's why it's so important to factor them into your budget from the very beginning. It's not just about the monthly payment, it's about the whole picture.
Totally agree. No one wants to be blindsided by unexpected costs. Well, we've covered a lot of ground today. I think our listeners are starting to get a much clearer picture of what it takes to get a mortgage in Kenya. We've demystified some of the jargon and explored the different types of loans available. But before we wrap up, we want to leave you with some actionable tips on how to actually score the best deal possible. So stick around. We'll be right back with those insider secrets. Okay, so we're back, and now it's time for the good stuff. We're going to share some insider tips on how to actually get the best deal on your mortgage, because who doesn't love saving money, right?
Right. Especially when we're talking about such a major financial commitment. It's like buying a car. You wouldn't just take the first offer you get, would you?
No way. I'm all about comparison shopping.
Yeah.
So where do we even begin? What's the first thing to look at when comparing mortgage offers?
Interest rates, for sure. That's number one. Even a small difference in interest rates can add up to big savings over time. And remember, don't be afraid to negotiate. Sometimes you can get a better rate just by asking.
It pays to sharpen those negotiation skills. What else should we be comparing?
Loan tenure is a big one. That's basically how long you'll be paying the mortgage for. Longer terms mean lower monthly payments, but
you'll end up paying more interest in the long run. It's like choosing between a sprint and a marathon, right? Shorter term is more intense, but you're done faster. Longer term is a slower pace, but you could end up covering more ground.
Perfect analogy. Now, remember those hidden costs we talked about earlier?
Oh yeah, those pesky fees.
Make sure you read all the fine print. Look for any extra charges or fees that aren't included in the interest rate. Don't be shy about asking questions if anything is unclear. And at the end of the day, remember you're in control. If something doesn't feel right, you can always walk away.
Yes, you have the power to say no. Okay, so we've learned a lot today. We've decoded mortgage jargon, we've explored the different types of loans, we've talked about qualifying and all those extra costs, and now we even have some tips for getting a good deal. So as we wrap up, what are the key takeaways you want our listeners to remember as they embark on this homeownership journey?
I think the biggest thing is just to be informed. Knowledge is power, right? Mortgages can feel really complicated, but if you break it down step by step, it's much less intimidating. Find a mortgage that really works for you and helps you achieve your goals. Do your research, compare offers, and if you need help, don't hesitate to reach out to the experts.
Absolutely. Be proactive, be informed, and be in charge of the process. Hopefully this deep dive has given everyone the confidence to take those next steps.
Homeownership is a journey, and like any big adventure, it's always best to set off with a good map, a reliable compass, and a sense of excitement.
Love it. And, we've focused a lot on the practical financial side of things, but let's not forget about the emotional side of homeownership. It's more than just an investment. It's about creating a space that's truly yours, a place to put down roots and build a future.
Couldn't have said it better myself.
Well, that's it for today's deep dive. We'll be back soon with another episode on a topic that matters to you. Until then, happy house hunting, everyone.